Kitco Mining's special coverage of the Deutsche Goldmesse is brought to you by Defiance Silver.
Recession, de-dollarization, fiscal cliff, banking sector wobbles. What is worrying Matthew Piepenburg the most? I'm with Matthew. He is partner at Matterhorn Asset Management. Matthew, welcome to have you back in Kitco.
It's great to be back. Lots to talk about as usual.
There is indeed. Let's talk about this banking crisis. So we've seen a couple of bank failures. It looks like that's being caused off of the high interest rates. Your assessment?
Yeah, the ironies abound. I think, Powell was on TV a couple days ago saying the banking system was sound and resilient. The next day, more banks are on the crisis or about to go into deeper crisis. And you had First Republic and PacWest heading deeper under the ocean. And so, look, the banking crisis is something that's been on our minds for a couple months, and was on our mind for years before that. We've always looked at banking risk as an extension of bond risk. I look at what's happening since Signature and then SVB and Silvergate and First Republic and et cetera, as really just a symptom of a greater problem in the credit markets, credit events. And the first one, which should have made more headlines and gotten more attention, was the repo crisis in 2019. There were stressors in the credit markets. When COVID came, we had the COVID crisis in March in 2020. There was a major fall in U.S. Treasuries with equities, which was pretty unprecedented. Of course, you had the gilt crisis in 2022 in October, and then come March of 2023, we have a banking crisis. They're each very different types of credit stressors and extremely extraordinary credit stressors, but they're all related to an inflated credit market, an unnaturally supported bond market, and then a policy of raising rates at 100 miles per hour in a very short period of time, too much, too fast, too late. And I think obviously the stress on the U.S. Treasury market, which is collateral for some of these banks, they were basically buying U.S. government bonds at a top. When there was a run on the bank, they had to sell at a bottom, and that affected their capital. And so you're seeing, I think, just the beginning. Even when this crisis came out in March, I said, you ain't seen nothing yet. There's going to be more to come. And there's only so much the FDIC can insure, and there's only so much they can do to bail out depositors. They may not bail out the banks. In some ways, you could argue, maybe they're going to let a lot of these regional banks. There was a time when we had 10,000. Now we have 5,000. Well, we have 2,000 at the end of this year. How many banks are going to need to fail? And how much will it cost to support these depositors to avoid really a contagion fear, a loss of faith fear? This loss of faith in treasuries, this loss of faith in central banks, this loss of faith in banking is going to have to be contained in some way. It'll be expensive. They may put gates on deposits like they do on hedge funds. We'll have to see. But I know that a lot of regional banks are going to have to raise their depositor, their checking account rates. If they're going to keep depositors from going into money markets, that's going to affect their margins. And if they get runs, that's going to affect their viability. So there's a lot of needles pointing at these regional banks right now, and it's tragic. Sadly, it's not totally surprising. But again, it's just one symptom of a much larger problem in our credit markets. And this credit market is artificially sustained by mouse click money, which is artificial policy of most of our central banks and our US Fed in particular. It's not that hard to pull these threads from debt and pull those other threads from central banks to see them unravel in banking sectors. So yeah, it's a scary time, and I'll repeat, we ain't seen nothing yet, in my opinion.
Are we going to see a reduction in interest rate costs, or are we going to see no?
It's a question of who really controls the interest rates, right? And is it the central bank the central banks in general, or the Fed in particular? Is it the bond market? Is it the yield curve? Is it natural supply and demand? Look, we talked about this a little bit last time. This notion that Powell can be Volcker has some, sympathy. You could argue he's trying to take the punch bowl away from the markets, the punch bowl away from, the central bank's balance sheet. He's trying to limit some of this liquidity and raise rates to fight inflation. There's a lot of problems with that narrative. But even if it were sincere, and I don't believe it is, I don't think you're going to beat inflation with rising rates, given the real level of inflation we have. But for Powell to try and raise rates in a Volcker-esque manner in 2022, 2023, compared to Volcker in 1980, when our debt to GDP ratio was 35%, not 135%, when public debt in the US was 800 billion, not 31 and 32 trillion, Powell cannot raise rates too high without breaking things. And he's been breaking things in the name of fighting a recession or fighting inflation, or not fighting a recession, fighting inflation, to hit this radical 2% inflation rate. It's kind of very stovepipe thinking. It's not looking at the ripple effects of everything else that's breaking as he does this. And this notion he's obsessed with inflation, I think, is a good public narrative. It's got great optics. I never believed from the very beginning that he was really going to beat inflation with rising rates in a Volcker-like redux. I think he saw what he saw in 2018, a recession en route, got to get that toolbox reloaded with rising rates today so we can lower them when we need to, and try to have something left in the Fed's toolbox. It's either print more money or play with the interest rates. And right now he doesn't want to print more money. He's going to raise rates. But when the time comes when the recession that we've all pretended doesn't exist is officially here, he's going to have to cut rates and probably, most likely, break out that mouse click money, break out that money printer to create some synthetic artificial demand for bonds to keep yields from spiking. Because at the end of the day, the bond market will determine interest rates and yields more than a central banker. It's my view.
Matthew, when I was talking to you last, the Ukraine war unfortunately had broken out at that time. You were warning, though, about kind of the first measures that came into place, and then that was using financial controls against Russia, and then what that could actually entail. What have we seen since that time?
Well, sadly, it just seems to have gotten worse. And a lot of things we talked about wasn't crystal ball related, it wasn't cynicism, it wasn't even partisan, it was common sense. That when you weaponize the world reserve currency against a country like Russia, as opposed to, say, Venezuela or Iran, you're going to have consequences. And in a sense, it really fell into the East's hands. When I say the East, I'm thinking of Russia and China. As I warned then, this is something that many countries, small and larger countries like Russia and China, have been looking for, a context and pretext to de-dollarize. And it's only gotten worse. This de-dollarization theme isn't just clickbait or headlines. It's a slow, steady process of a breaking of the ranks with the US dollar. Again, what I warned about then has only gotten worse. You had over 14 trillion in US dollar-denominated debt globally, not just owed to US banks, but settled in US dollars. As Powell raised rates, that made the dollar more expensive. So other countries were already afraid of rising rates and an expensive dollar. But then when the sanctions came in and you weaponized that dollar and you froze someone's quote-unquote checking account, someone's FX reserves, if I froze your checking account, you wouldn't recommend that bank to me or to anyone else. And so China and Russia and the rest of the world are looking with eyebrows raised instead of 1,000 times. What have they just done? If they can do it to Russia in the name of politics or the name of military geopolitics, they can do it to us 6 months, 10 months, 12 months down the road. And so you're seeing a massive, slow but steady, quite obvious movement to reach bilateral agreements. We have 41 countries right now in bilateral agreements with each other to make trade settlements outside of the US dollar. And then you've got these interesting percolations from Russia and their finance ministers, whether it's Babokov or Sergei Glasiev, we can read their white papers. And again, this isn't conspiracy theory, this isn't tinfoil headed. There is a genuine effort, thinking much longer term than the next 6 months or 6 weeks of the first headline, of coming up with trade settlements and trade settlement currencies that are gold-backed and outside the US dollar. I think what we've seen with the West in general and the US in particular, because this is, in my opinion, a proxy war, a financial war against Russia, fought on Ukrainian soil with Ukrainian citizens and soldiers as victims and Russian soldiers as victims, was a financial war. And the idea that we were going to puff our chests and get 20 minutes, 30 minutes, or 3 weeks of positive headlines about how strong we are about freedom, democracy, and that's all fine. But at the end of the day, it's a financial proxy war, in my opinion. And getting the headlines that we can squeeze Russia by freezing their FX reserves, taking them off the SWIFT accounts, getting them no more SDR access, that just allowed Russia and China to look around the world with Saudi Arabia, with Venezuela, and other BRICS nations to find ways to say, we need to get slowly and steadily away from the US dollar settlements and trade settlements. And they're working quietly behind the scenes to find new agreements. In the meantime, they're also coming up with ways to find new currency baskets. And they're also really, truthfully, even with gold price, they're coming with this Moscow World Standard, an alternative to the LBMA agreement. All these things are slow creep. And they're also stacking physical gold, and central banks are stacking physical gold. They're recognizing that after decades of living beyond our means in debt in the West, and solving that with mouse click money, monetizing our debt with fiat currencies, that not only are we inside these countries losing faith in our fiat currencies, the rest of the world is too. And again, it's not going to change overnight. The world reserve currency is not going to change overnight. The dollar is still going to be there, and it's still going to be the world reserve currency. But as a payment system currency, as a hegemonic currency, as we warned last time we spoke, that is changing. And I think as the East rises, and this is not overnight, it's slow and steady, as the East rises, they know eventually, and this is something Dominic Frisby was talking about today, they're going to need to have more gold, because he who has the most gold wins. Because they're going to announce at some point, we have a lot more than the World Gold Council is announcing. We're going to cover a currency, a new trade currency with physical gold. And the world's going to trust that more than they even trust each other. They're going to trust that gold chaperone. Again, this is not something we're going to see overnight, but the same thing we talked about almost a year ago is really moving in that direction. Alternatives to fiat currency, alternatives to the US dollar as a trade currency, alternatives to the US dollar as a respected currency, because the US dollar is losing respect and losing friends politically, financially, and inflationarily. So I think it's a very serious watershed. Grant Williams and I said in March of 2022, what we just did in Russia with those sanctions is as big a watershed in the ripple effects as what we did in August of 1971 when we got off the gold standard. Things are changing, alliances are changing, trust is changing. Trust is hard to quantify, but I think the genie's out of the bottle now. As I said then, it's not going to come back, and so we're going to see known and unknown consequences. It's not gloom and doom. It's the direct result of, again, short-sighted, headline-grabbing politics. Sanctions, Russia bad, U.S. West good, Ukraine good, Russia bad. Again, spend hours debating that, but that quick, myopic response was ultimately shooting themselves in the foot, or as others would say, in the head. We've done the same with ESG. We've done the same with our COVID policies. Things we do for immediate attention have longer-term effects that aren't really thought out, it seems to me, in the decision-making capitals of the world, and certainly in the West right now.
The other financial crisis that people see that is in the horizon right now is happening this summer. That's happening in the U.S., and that would be with the fiscal cliff. So it seems like the Congress right now is at loggerheads. You have a Congress that is highly polarized. I think it's more deeply polarized than we've seen in the past. So we need Kevin McCarthy to kind of actually be able to put people together and see if they can actually make budgetary requirements, or rather that the U.S. is not going to be paying its bills. We've been talking about de-dollarization. We've been talking about what is happening in terms of like a recession, but add the fiscal cliff to the mix. And how do you view that in terms of other crises, Matthew?
Again, the more things change, the more they say the same. Here we are towards another debt ceiling, another political crisis, another currency crisis, another debt crisis. Again, they're all tied together. There's a lot of things to say about that. By the way, the U.S. is running twin deficits, not just a fiscal deficit. I mean, we're running a trade and fiscal deficit. In my opinion, and because I'm so cynical about politics, left, right, or center, that there's going to be a lot of headline making. There's going to be a lot of more contentious debate. But at the end of the day, there's very unlikely that the U.S. government is going to default on its debts. I think that's very unlikely. And yet, they will make this, as they always do, Spannung, a lot of excitement, a lot of tension, a lot of rising action before they eventually cave. They get 30 seconds of fame, claiming to be tough on debt, claiming to be tough on excessive spending, claiming to look for a balanced budget. But eventually they're going to have to cave, write a check, and solve this problem by sending it on a credit card that the next generation will pay for. That's politics in America. It's getting more polarized, there's no doubt. It's palpable in the U.S. But what's interesting this time around, in the past, 2011, 2014, as we approached a debt ceiling in a highly politicized environment, the bond markets started to react, and there were moves. The bond markets make people's eyes roll over. I get it when you talk about yields on 2-year or even 4-week treasuries or T-bills and contango and backwardization and all that. Without getting into all that complexity, which is boring, the simplicity is, though, if you just look what happened in the last 24 to 48 hours at something as boring as the yield on a 4-week T-bill, what we just saw in the last 48 hours is a 100 basis point spike in the yields on a 4-week treasury. There's a lot of implications with that. There's a lot of implications on the short end of the yield curve, but what that is really saying is money markets are dumping their T-bills because they're worried that maybe, just maybe this time around, it's better to take some cash off the table now in case we do default on our debt. I don't think we will, but this distrust in Uncle Sam's dollar and Uncle Sam's IOUs is really hitting record levels now that I've never seen, not in '87, not in the 9/11 crisis in 2001, not in the subprime crisis of 2008. And so, again, these are boring bond market discussions. This is about yields and futures and contango and contraction and spreads. But it really just comes down to even money markets and even other banks aren't trusting each other's collateral. They're not trusting each other's loans. They're not trusting Uncle Sam's IOUs. And they're not even trusting Uncle Sam's dollar. And so, again, not gloom and doom, not conspiracy. These are mathematical and political changes that are happening in real time. Unfortunately, more people just don't understand how they're all interconnected. And again, no fault of their own. They've got their own professions, lives, and worries. But there's a sense, it's palpable, that things are breaking, that things aren't being handled correctly, financially and politically, left or right. And so it's an interesting time, both in perception and this kind of angst that we feel, but when you get under the hood and look at the math and look at the yield curve and you look at the yield spreads and you look at the volatility in the futures market on the treasury or on the T-bills, it's unprecedented right now. Unprecedented volatility we have never seen before, even prior to market crashes or other recessions. So to me, as a geek who looks at yields and bonds and then currencies and debt and politics, it's a really fascinating time. And I think the more you get into the critical thinking on this, the more you look under the hood, the more you inform yourself. It's almost too much information. It's overload. It's distressing. It just is distressing.
Matthew, you're looking under the hood. You're looking at what the bonds are doing. You're looking at all of these charts and moves. So what does an investor do?
It's, of course, here comes Matt talking his book, talking his bias. I clearly have a bias. I clearly have a book, so to speak. Gold is one answer. It's not the only answer. It's a lot of things. If you look at last year's performance in risk parity portfolios, 60-40, 70-30 bond stock portfolios, you see how much they underperformed energy and commodities, real assets, hard assets. So in general, you have to start thinking not where the puck has been for the last 20 or 30 or 40 years, but where is it going to be for the next 10 to 20 years? And you have to think more like an investor than a trader. So in one area, you've got to get away, as I always said, from the belief that credit markets or bonds will offset risk in equity markets or stocks. That was the bread and butter of the financial industry for decades. There's been a seismic shift. So that 60-40, 70-30 risk parity bond stock portfolio is not the hedge or the safety that it used to be. Nor can you believe, like you could in the past, that you bite your stick through a downturn and expect the Fed to print more money to save you. It is possible. But for the Fed to save you and to save your credit and stock portfolios, they're going to have to debase the currency. So you have to look at real assets. And again, you have to look at metal, and you have to look at monetary metals in particular, not as a speculation asset, but as an asset that sits there and doesn't do anything, but as currencies go down, it rises in value. It protects, it insures you against the death of your purchasing power, regardless of how CPI inflation is officially reported or unofficially reported or felt. So you need something to protect that currency risk. Again, I'm not saying put 100% of your portfolio into gold. I'm saying you have to insure against inflation, however reported, but regardless of CPI numbers, we are all feeling the inherent purchasing power of all our currencies getting whacked and kneecapped by the minute, by the second, by the day. And I absolutely am certain that, well, I'm very confident that allocation to gold, whatever the percentage, is a must. It was always a must. The joke was put 5 to 10% in gold and hope you don't need it. Now you need to put money in gold just because you know you need it, and you need to protect that purchasing power. So again, it's getting away from the old bread and butter, what worked during a highly inflated, highly artificial, highly stimulated period, as we head into a recessionary period. In recessions, the S&P reverts to its mean. You got to protect against that. You can go to cash, but then you worry about inflation. So you can go to short-term, very low duration, money market cash equivalents. You want to have some dry powder. You want to protect against that inflation in precious metals, in particular in gold. I think silver has an interesting story too. And you want to just brace yourself for the inevitable recessionary effects that has on stock markets in particular. So, and there are also other areas you can look at. You can get REITs that are in agricultural land, or you can look at industrial stocks. But the classic kind of seeking risk and chasing risk in tech or in the NASDAQ or these are things that I think worked for many years when we had a tailwind. They are going to be very dangerous in a headwind. I think that the indicators of this headwind are pretty obvious, whether it's the FOMC themselves talking about maybe a softish landing. That's their way of saying a recession's coming. If you look at the Conference Board of Leading Indicators, it's been right every recession for the last 6 years. When it goes negative, we're deeply negative. I'd say that's very recessionary. ISM manufacturing data, very recessionary. Even the oil price right now, with all the OPEC, cuts in productions, oil is actually, the futures contracts for oil is actually in what they call backwardization. The oil markets are seeing a lower price down the road than they are seeing it today not because they're cutting oil. That should make production, when you cut production, oil price should be going up. What they see, like the Eurodollar futures market, what the oil futures market is saying, we see a big recession coming, a lack of demand for oil, and hence, they're getting ready for something dark to happen in the markets and in the economy. So I think when you look at these indicators, we're definitely, if not in a recession, because we changed the definition of recession last year, we're clearly heading towards one. And I think, you have to prepare your portfolios for a recession. For me, of course, precious metals are a part of that. But certainly getting away from that risk parity, the old school thinking that bonds are going to protect you in a world where bonds are just another highly inflated risk asset, and not the protective hedge they were in our father or grandfather's era. So yeah, it's rethinking. Ronnie Sturfel had a great graph he called the chart of the decade, the ratio of the S&P to commodities or equities to commodities, and these mountaintops and mountaintops. And right now, real assets are down here at the bottom, the S&P's up here. As that cyclical rotation happens, those who were thinking ahead, where the polo ball or the hockey puck, you play where the puck's going to be 5, 6 months, years out down the road. So your portfolio rises as stocks and credits fall. And again, the only thing that could keep a stock market going is if we print trillions more, like we did in March of 2020, to take that 36% drop and pump it back up with trillions of mouse-click dollars. So then it's a Pyrrhic victory. You save the markets by destroying the currency. And again, what good is a portfolio that's up 10% or flat if your purchasing power is down 20%, however the CPI is reported? And I think as you understand currency risk, and when it comes between a choice between letting the system fail, that includes banks and the S&P, and the too big to fail banks and what's left of the regional banks, or letting the currency die, the decision makers will let the currency die. That means more inflation, maybe a recessionary period in the middle, which is deflationary, maybe rate hikes that are deflationary, but they're going to have to monetize their debt. They're going to have to support their bond market artificially. The only demand for that bond is from a mouse clicker. That is inflationary, and that is debasing your currency. It's not gloom and doom. It's just the only tools they have left. And so, again, talking the book, talking the bias. I like to say I'm talking my conviction. You can challenge my conviction, you can challenge my views, and you should. But we're not alone anymore. It's no longer the tinfoil hatted gold bugs. It's too simple to say that anymore, because more and more, whether it's great hedge fund managers and popular thinkers, or whether it's even Tucker Carlson, people see the debasement of our currency. So from the journalists to hedge fund managers to former bankers to current bankers to gold bugs like us, who've been right, I think, for a long time, it's now becoming fairly mainstream. And I think that's a very good thing, that people are becoming more informed. And they are asking critical questions, and they should. They should question me, they should question the Bitcoin camp, but it's pretty obvious that the currency is under massive threat. And if you just look at a chart of gold, a gram of gold versus the US dollar since 1971, the purchasing power of that dollar is 99% gone. And so it's already clearly in motion. And that's a long-winded answer to say, think very carefully about how you prepare for the next 5-6 years, because they're going to be very different than the last 5-6 years.
Is there going to be an uptake in gold, though? I mean, if you have that thesis right now that the financial is going to be falling apart right now, it depends on the sting pack that people are actually going to be purchasing it. Gold has not been bad this year. I was looking at the GDX. It's up about 30% this year, but that's just based upon what's happening with the gold miners. Gold hit its all-time high, I believe, this past week at just about, 2085 right now. But still the same as well, too. It seems like a sector that could use a little bit more love, to say the least.
I think it's only getting started. But when I say the gold bull market, I think has already started. I think the fact that it weathered the temporary inflationary that was in the strong US dollar, there were some headwinds, and it should have done better, they thought, in an inflationary environment with a geopolitical crisis. Why wasn't gold hitting all-time highs last year? Well, in US dollar terms, it wasn't. In the yen and the pound and other currencies, it was. But that strong US dollar last year was a real headwind. And as I think we spoke last time we spoke, I hated to use the word transitory, but that strong US dollar was transitory. It wasn't sustainable. And already the US dollar is down 11% this year from the beginning of the quarter. And that weaker dollar is helping gold move. But gold can move in a high rate environment, a low rate environment. It can move in an inflation or a deflation market. It can move up in a strong dollar or a weak dollar environment. Why gold is moving right now, I think in the real narrative today, gold does love chaos. Gold does love mad money printers. Our best allies are central bankers who continue to debase their currencies through mouse click money, whether it's euros or yen or dollars. And I think there's just more and more recognition that there is no natural solution for the financial crisis, which is a debt crisis, which is a central bank crisis, because that debt is monetized by artificial money that's printed out of nowhere. And they're seeing the purchasing power in their currencies. You don't have to be in Argentina, which is obvious. You can be in New York, where it's less obvious, but clearly palpable, that the purchasing power of your currency is getting weaker, regardless of what the Fed says. That lack of faith and the clear and more palpable evidence of a weaker currency is forced people to rethink gold. Gold is clearly trending north. That does not mean gold will not have pullbacks. We are hitting all-time highs, but that does not mean gold moves up and to the right in one direction. And as many smart gold watchers and gold trackers have said, if we have a major market moment like we did in March of 2020, gold can be very sympathetic. It can go down, it can pull back, and then it rips in a higher direction. It keeps getting, it's when it goes back to lows, they're always higher than the previous lows, and when it launches, it always goes higher. The fact that we're in new highs now is just the beginning. There could be pullbacks, absolutely. It's not going to go straight in one direction. But I think it's more obvious that we are facing a currency crisis because we're facing a debt crisis. And one very obvious alternative to that is physical precious metals. Certainly the cryptos and the Bitcoin camp are gonna make a similar argument for the similar thesis about sound money. I'm not here to criticize cryptos, it's just not. And typically though, when we had a major sell-off, cryptos tended to behave like tech stocks. We'll see if that narrative changes. I'd like to see crypto do well. My choice is something a little more stable. It's physical gold, but yeah, we're hitting new highs now, but I think looking back in 2 or 3 years, these numbers are going to seem like cheap numbers. But again, doesn't mean it's straight and to the right. It can certainly have pullbacks, especially in a market meltdown.
Matthew, around hard assets, so leaving aside gold, but talking about your coppers and then talking about your oils as well too. What do you still do though with commodities like these, which are going to have very much exposure to what's happening on a recessionary basis? Yeah. Dr. Copper, for example.
Yeah, I mean, I'm less, and I'll be honest, I'm much more of a monetary metal thinker, and I look at these other real assets with less expertise. There's better people here to talk about that. I look at a commodity index or a commodity ETF as just a way to play the whole sector outside of the precious metals. And again, I look at that equity to commodity ratio, that historical chart. It's fairly much like, 7 sets of a good wave if you're surfing. That last wave is always the biggest, but it's clear that the commodities across the board and other metals, industrial metals, including frankly silver, which is an industrial metal in some ways, not just a monetary metal, but copper and others, whether it's even in a recession in the West, there's going to still be infrastructure building. There's still, even if it's something almost in an FDR way, there's going to be infrastructure building in the East and the West. And I think as equities fall and bonds fall concomitantly, simultaneously, as they did in March 2020, there's going to be institutional movement back into this commodity play. And again, it's not just, gloom and doom, and it's not just, I promise it'll come. It is coming. It's just cyclical. And as these risk assets go down, these commodity assets as a basket go up and to the right in a pretty meaningful way. The only caveat to that whole thesis, though, is if risk assets do what they did in 2020 in March and start to head south real fast, because that 36% fall in the S&P in March of 2020 could have been 56, 66, or 76%. We printed trillions in a matter of months. We brought that back up towards new highs. And so theoretically, if you argue if the markets go into a recessionary tailspin and they spiral past 36, 40% drawdowns, could the Fed mouse click enough money to support that market? But if they do, which is feasible, that would require so much mouse click money that it would so much debase the currency that those real assets like commodities are still going to do well. Because the Fed has really put itself in a corner now. People are losing faith in its old tools. Those tools are like martinis that are losing their kick. And now, instead of just the high, we're going to start to get the hangover and frankly, the liver damage and the cirrhosis and possibly something more fatal. And again, it's common sense. If you track currencies, if you track debt, if you track yields, and you track the purchasing power of the major currencies, including the world reserve currency, which we've weaponized and politicized, and by doing so, have shot ourselves in the foot and pushed more money to the east, more gold to the east, and more alternative currency structures to South America to the east, and less towards the US. Not the end of the dollar as a world reserve currency, not the end of the dollar, not the yuan replacing the dollar or the ruble replacing the dollar, but a clear seismic shift in a multi-currency system where the dollar has lost its varsity status. Just has.
Matthew, it's always a pleasure to see you here in Frankfurt and making time for Kitco.
It's a great pleasure. I always enjoy talking with you.
My name is Michael McRae here at Deutsche Goldmesse for Kitco Mining.
Kitco Mining's special coverage of the Deutsche Goldmesse is brought to you by Defiance Silver.